Many economists breathed a sigh of relief after March's Consumer Price Index was released. Yes, the report showed the annual US inflation rate was the highest since 1981, but it also suggested inflation may have peaked and will begin to slow down. Since then, however, markets have shown investors expect higher inflation for longer. I'll explain why longer-term inflation expectations have picked up, what we're seeing in the market that shows this, and what that means for the broader economy. Let's get into it.
I think we're at peak inflation, and because of that, we're at peak fear.
Investors don't think inflation's going to keep rising, but they also don't think it's going to come down very quickly. That's due to some new uncertainties in the world, and some old ones being exacerbated. The first is the war in Ukraine, which has continued longer than most expected, and currently has no end in sight. That's keeping pressure on oil and wheat prices, which are major inputs to a slew of other food and household products. There is also the recent COVID outbreak in China that has led to lockdowns and further disrupted supply chains. And housing prices are still rising at a double-digit pace in the US, outstripping economists' expectations. When investors expect high inflation, bond yields rise and prices fall. So we can see this in markets. Recently, we've seen yields on longer-dated government bonds, like 10, 20, and 30-year maturities, reaching multi-year highs. The 10-year break-even rate, which measures investors' inflation expectations over a decade, touched a record high in April, rising above 3% for the first time since tracking began in 2003. I asked Rick Reeder, managing director at BlackRock, about the market moves. He said that inflation has gotten stickier, meaning it will be harder to get rid of. He agrees that inflation is probably peaking, but warns it's not like you're rapidly going down the other side of a mountain. It's more like you've climbed the mountain and now it's going to be a gentle descent down from these levels of inflation. Stickier inflation means prices continue to rise, which will add more pressure to family budgets. It'll also put things like home ownership out of reach for more people. But a slower, yet still elevated pace of inflation could mean that wages start to keep pace with overall price increases. So average Americans could start to see real pay increases for the first time in quite a while. Higher inflation also creates an environment where there are more assets to invest in that offer some income with less risk. That's especially good for retirees and those on a fixed budget. But any positive outcome for the economy hinges on the Federal Reserve being able to rein in inflation.
To be sure, runaway inflation has never happened in the US, and few think it's likely now. But runaway inflation erodes the value of a country's currency, hobbles the economy, and makes even basic household goods difficult to afford.
That's why central banks prefer to inflict a little pain by raising interest rates to slow down the economy than let inflation get out of control. The Fed has made clear recently that they think there's a lot more work to be done. They're expected to raise US interest rates at twice the normal pace at their next meeting. And the Fed Fund futures market shows investors believe they'll raise rates double time at multiple meetings this year. Subhadra Rajappa, head of US rate strategy at Societe Generale, tells me that inflation expectations are also rising because the market is starting to question the Fed's ability to be effective at this point. The inflation battle has economic organizations like the World Bank, IMF, and OECD all lowering their expectations for global growth and increasing their expectations for inflation. So buckle up, because this could be a bumpy ride. Andre 3000 of the legendary Outkast had some wise advice for times like this. He said, "Promise me you gon' stack, promise me you gon' ball, promise me you'll invest 3/4 of it all." That's all for now. I'll see you next time.